Ever get that feeling? Like you're just constantly trying to keep up with the business world. There are just so many companies out there. And it seems like there's never enough time to really, truly dig in and understand what they're all about.
It can be overwhelming.
Oh, absolutely. So today we're going to do the heavy lifting for you.
Okay.
We're diving deep, deep, deep into this really fascinating Hong Kong-based company, one that just recently listed on the NASDAQ, called Raytech Holding Limited. Or, for those following along at home, that's RAY, the ticker symbol.
And right away, what I think is really interesting about RAY is, they're not a household name. You won't see their brand plastered all over store shelves, but they're kind of these behind-the-scenes experts. They're the ones designing, sourcing, and wholesaling this huge array of personal care and lifestyle electrical appliances for it, like all the big international brands. I mean, think about it. Everything from hairstyling tools to trimmers, even those little eyelash curlers we use or neck massagers. It's all part of their world.
I know, right?
Yeah.
It's a pretty diverse portfolio when you really start to think about it. I mean, we're talking about hair dryers, straighteners, facial shavers, nail clippers, even those tiny portable mini fans that are so popular these days. It seems like they have a hand in a lot of the everyday essentials we rely on.
Absolutely, they do.
So what we're going to do today, our mission, if you will, is to cut through all that noise, all the clutter that's out there. We're going to try to give you, the listener, the core insights into RAY. We're going to look at their business model, we're going to assess their financial health, and then kind of look ahead, try to get a sense of their potential for the future.
Sounds good.
And to do that, we've drawn on some pretty detailed research reports, which of course we'll link in the description for those who want to dive even deeper.
Right.
But let's not get ahead of ourselves. First things first.
Okay.
What exactly does RA do? Can you give us that clear picture?
Sure. So if you zoom out and look at the bigger picture, RAY sits firmly within the consumer staples sector. And more specifically, they're operating within the household and personal products industry.
Okay.
But their business model, it's primarily business to business or B2B. What they do is they come up with the concepts and designs for these appliances, they figure out the most efficient way to manufacture them, and then they sell them in bulk to those big name brands we were talking about earlier.
Gotcha. So even if your hairdryer doesn't actually say RAY on it, chances are they probably played a pretty big role in getting it made.
Right.
Okay, so we talked about their approach, but to really grasp how involved they are, we've got to break down their product categories a bit. I mean, you mentioned everything from hairstyling to those little tools. What does that look like in practice?
Yeah, so they have a few main categories. There's the hairstyling series, which, as you might guess, includes all the standard stuff like dryers and curling irons. Then you've got the trimmer series, and that covers facial shavers, nose trimmers, eyebrow trimmers, really the whole gamut.
Makes sense.
But it goes beyond that. You've got standalone products like the eyelash curler, and then they've got a whole neck care series, which features things like massagers, even posture correctors. And then, of course, there's the nail care series, all your clippers and files and buffers, and a separate tooling category, which includes like tweezers, scissors, combs, and those sorts of things. And then they've even got an other category that seems to be a catch-all for things like body brushes, facial brushes, those sonic peeling devices that are becoming popular, even those handy little fans we talked about.
I'm starting to see why you called their portfolio diverse. It really is all over the place. So are they basically playing in a huge market here? I mean, is there even room for a company like this?
Oh, the market is definitely there. In fact, it's enormous. The research we've been looking at actually puts the global medical devices market. And remember, those personal care appliances kind of fall under that umbrella at a whopping $640.45 billion in 2024.
Wow.
Yeah. And the projections are saying it's going to keep growing, like well over $1 trillion by 2034. We're talking about a steady annual growth rate of about 6%.
6%. That's pretty impressive considering how large the market already is.
Yeah.
It's funny you mentioned medical devices because I was reading that the COVID-19 pandemic actually played a role in this whole thing. Right. Like, sped things up a bit.
It definitely did. I mean, it really highlighted how important these health and personal care solutions are becoming.
I can see that. So what else is driving this growth? I mean, is it just a temporary thing or are there more fundamental factors at play?
Oh, it's definitely more than just a passing trend. Technology is advancing so quickly, especially in areas like AI-driven diagnostics and 3D printing.
Right.
These advancements, they're really pushing the boundaries of what's possible within the broader medical device field.
Okay.
And at the same time, you've got this growing emphasis on early disease detection and preventative care.
Right.
People are becoming more proactive about their health.
Mm.
And then, of course, there's the fact that healthcare investments are increasing globally. You've got governments launching initiatives to improve healthcare infrastructure. And unfortunately, the prevalence of chronic diseases is rising, and the global population is aging.
Yeah.
So when you combine all those factors, it creates this really powerful engine for growth in the medical devices sector.
It makes a lot of sense. So it sounds like RAY has found themselves in a pretty good spot market-wise. But what about the competition? Who else are they up against in this arena?
Yeah, so the competitive landscape, it's definitely not a cakewalk. You know, you've got those big established players like Philips, Braun, Panasonic, Remington. These companies, they have the advantage of really strong brand recognition, extensive market presence. They've been around for a while.
Mm.
But then on top of that, you've got this wave of digital health solutions coming in.
Yeah.
Things like telemedicine and wearable devices. And those are creating both new forms of competition and, interestingly, opportunities for collaboration. So for a company like RAY, it's going to be really crucial to stay on top of things.
So how do they do that?
It's about constant innovation.
Okay.
They can't just keep churning out the same old products. They need to differentiate themselves, come up with unique features, sleek designs, things that set them apart from the crowd. And then forming those strategic alliances, that's going to be key for staying ahead of the curve.
Okay, that makes sense. Now, something we haven't really touched on yet, the whole regulatory environment. I mean, we're talking about products that people use on their bodies, some of them with health claims. I'm guessing there are a lot of hoops to jump through. Right.
Oh, absolutely. The medical device industry is one of the most heavily regulated out there, and for good reason. We need to make sure these products are safe and effective. So in the US, you've got the FDA calling the shots, and in Europe, it's the EMA. And they've got really strict approval processes. I mean, everything from design and manufacturing to labeling, and even what happens after the product's already out in the market, it's all scrutinized.
Right.
And it's interesting because the EU recently implemented this new regulation, Regulation 2017-745. And while it's aimed at boosting safety, it's actually created some challenges, especially for smaller companies.
How so?
Well, the costs of complying with all these regulations, they can be significant.
Yeah, that makes sense. I also remember reading that not every device is treated equally when it comes to regulations. Is that right?
You're exactly right. So they actually categorize medical devices based on the level of risk associated with them.
Okay.
So you've got Class I devices. Those are considered low-risk things like bandages.
Makes sense.
Then there's Class II, which is moderate risk. Think of things like powered wheelchairs.
Ouch.
And then at the top of the pyramid, you've got Class III devices. Those are considered high risk, things like implantable pacemakers.
Right.
So each class is subjected to a different level of oversight.
Okay.
And even though RA mostly focuses on personal care appliances, they still need to be aware of all these different frameworks, especially if they're making any health-related claims about their products.
So basically, setting up shop in this industry is not for the faint of heart.
No, definitely not. The research really highlights these significant barriers to entry. You've got high upfront costs for research and development because you need to be constantly innovating in this field. And then you've got those stringent regulations we talked about, these lengthy and complex approval processes.
Yeah.
And of course, you're going up against these established brands with tons of customer loyalty, huge distribution networks. And it takes significant capital investment just to get your manufacturing up and running, meet all the quality control standards.
Right.
And then there's this other interesting challenge. Sometimes there's a disconnect between the super cool technological advancements that are happening and actually applying them in medical devices.
So it's not always a straightforward translation from a cool idea to an actual product.
Right. And then on top of everything else, in the US at least, you've got this incredibly complex healthcare reimbursement system. Figuring out how to get these products paid for, well, that adds a whole other layer of difficulty.
I bet. So RAY has managed to break into this market despite all of that. That's pretty impressive. What's their secret sauce? What sets them apart?
Well, when you look at RAY's competitive strengths, there are a few things that stand out. First off, they've got a really strong focus on innovation. They're not content with just churning out the same old products. They're constantly coming up with new appliances, trying to address the evolving needs of consumers.
Okay.
And the report we were looking at specifically mentioned their recent launch of hairstyling tools with advanced temperature control.
Oh, cool.
Yeah, so that's a good example of how they're trying to stay ahead of the curve.
Hmm.
And then you've got their product range. Remember how we talked about how diverse it
Yeah,
was?
it's pretty expansive.
Well, that breadth actually works to their advantage.
Okay.
It allows them to cater to a much wider range of customer demands. And then, probably one of their biggest assets is the relationships they've built with those big international brand owners. I mean, having those stable, predictable revenue streams, that's gold in this business. And then finally, they've really got their sourcing and manufacturing down to a science. They can produce high-quality goods in a way that's very cost-effective.
So would you say they're kind of like the Ray-Bans of the personal care world? That mix of heritage and innovation.
That's a really good analogy, actually. Ray-Ban's been able to maintain that iconic status for decades because they understand how to blend their heritage with innovation.
Right.
And it seems like RA is trying to strike that same balance in the personal care market.
Makes sense.
Yeah.
Okay, so we've talked about the company, the market, the competition. But what about the people actually running the show? What can you tell us about RAY's management team?
That's a great question, and it actually highlights something really important. The research we've been looking at, it doesn't give us a ton of detail about the specific individuals on RAY's management team or their track record. But we do know that they successfully launched their initial public offering on the NASDAQ back in May 2024. So that suggests they've got leadership that's capable of navigating complex processes.
True.
But for a truly thorough assessment, we'd need more information on their backgrounds, their expertise, their overall strategic vision. That wasn't really covered in these sources.
Fair enough. I mean, it is still fairly early days for them as a publicly traded company, so maybe more information will become available as time goes on.
Yeah, that's possible.
But in the meantime, we can still look at how they're using the resources they have.
Right.
So what about their capital allocation strategy? How are they spending their money?
So from what we can glean, their strategy seems to be all about reinvesting in their core business. They generated over $6.4 million in gross proceeds from the IPO, and it seems likely that they'll use this capital to boost their research and development, maybe expand their product offerings, and strengthen their position in the market.
Okay.
We didn't see anything in the sources about mergers and acquisitions, share buybacks, or dividends, so for now, at least, it looks like they're laser-focused on organic growth.
So business model seems solid, focus on reinvestment.
Got it. Now, let's talk numbers. What does RAY's financial health actually look like?
All right, so when we look at the key metrics, we get a pretty interesting picture. Their market cap currently sits at about $37.51 million, and they've got a PE ratio of 13.73. And that basically tells you how much investors are willing to shell out for every dollar of the company's earnings.
Okay.
If we look at the trailing 12 months, their revenue is $9.94 million with a net income of $1.05 million. And that translates to earnings per share of $0.06.
Okay, so those are the snapshot figures. What about the trends over time?
Well, the recent trends are actually pretty encouraging. In 2023, RAY had some impressive revenue growth, reaching $66.97 million, which was a big jump, like a 47.13% increase year over year.
Oh. Yeah, and their earnings followed a similar upward trajectory. They hit $9.94 million in 2023, which was a whopping 57.91% increase year over year.
That's amazing growth. It really does sound like they're gaining some serious momentum in the market. But are they actually making money on the products they're selling? What do the margins look like?
Oh, yeah, they are definitely profitable. In 2024, their gross profit margin was 22.26%, and their net profit margin was 14.84%.
Okay.
Now, if we want to put those numbers into context, the average gross profit margin across all industries is around 36.56%. So RAY is a little below that.
Okay.
But when you look at the average net profit margin, which is about 8.54%, RAY is way above that.
Interesting. So their gross margins might be lower, but they're really crushing it when it comes to net profit. What do you make of that?
It could mean a couple of things. It could indicate that their production costs are lower than average, or they're really good at managing their overhead, keeping those operating expenses in check.
So basically, they're really efficient at converting sales into actual profit.
Exactly.
Okay, makes sense. Now, beyond just profit, what about their ability to actually generate cash? How does that look?
So when we talk about cash generation, we're talking about free cash flow, or FCF.
Okay.
And this is a really vital metric because it tells us how much cash a company is generating after they cover all their operating expenses and their capital expenditures. It basically shows how much money they have left over to play with.
Okay.
And that's important for things like funding future growth, paying off debt, which, by the way, RAY currently has a debt-free balance sheet, which is a big plus, and potentially even returning some value to shareholders down the line. And the research emphasizes that when you're looking at free cash flow, you also want to consider things like inventory levels, how quickly they're collecting payments from customers, how quickly they're paying their own suppliers.
All right.
All of those factors can give you a more complete picture of a company's financial health. But generally speaking, healthy free cash flow is a good sign.
And speaking of good signs, the report really highlighted RAY's financial stability. What are the key takeaways there?
The big takeaway is that Raytech Holding Limited seems to be in a really solid financial position. They've got that debt-free balance sheet, which significantly reduces their financial risk.
Okay.
They're also generating positive free cash flow, meaning they have more cash coming in than going out. And as we discussed, they've been pretty consistently growing their earnings in recent years. All of that points to a sustainable and profitable business model.
It does sound like they're on pretty firm ground. But it's not just about the numbers, right? What does the market actually think about RAY? How are they being perceived out there in the investment world?
That's a really important point, because even though the financials are strong, the market perception of RA stock seems a little mixed right now. You know, even with those great results, their stock price has been a bit volatile since the IPO.
Ah.
And MarketBeat, they have this proprietary rating system called Market Rank, and they gave RAY a score of 53.
Okay, and what does that mean exactly?
Well, it basically means that RAY is right in the middle of the pack when compared to all the other companies that MarketBeat tracks.
So, not bad, but not stellar either.
Mm-hmm.
What do you think is contributing to this kind of lukewarm sentiment?
There are probably a few things at play. So while their recent reports have shown good revenue growth, some investors might be a little worried about those increased operating expenses we mentioned earlier.
Right.
And then you've got the analyst ratings. They're mixed, with some recommending to buy the stock and others saying hold for now. The average price target is around $10.88 Canadian cents. And then finally, you've got something called short interest, which basically measures how many investors are betting against the stock.
Right.
And while it's recently decreased by 35.56%, it's still been kind of all over the place, which tells you there are some differing opinions out there about RA's future performance.
So it sounds like the market is still making up its mind about RA. Now, I'm curious, who are the people that actually own the company? What's the ownership structure like?
So the information on that in the sources we looked at, it was a little sparse.
Okay.
But they did mention that insiders, meaning the founders and management, they own a significant chunk of the outstanding shares.
Interesting. Does that have any implications for how the company operates? I mean, does it give them more control or flexibility or...
Yeah, it can actually have a pretty big impact, especially in these entrepreneurial companies like RAY. You know, having that concentrated ownership among insiders can really influence the decision-making processes, the dynamic between the founders and the management team, and ultimately the strategic direction of the company.
I see.
To get a really clear picture, though, we'd need more data on institutional ownership. Like, who are the big investment firms that hold shares? That would help us understand the broader landscape a bit better.
Makes sense. So we've looked at RAY's business, their financials,
Right.
how the market perceives them, who owns them. Now let's bring it all together and look at the big picture. Time for the SWOT analysis.
Yeah.
You know, strengths, weaknesses, opportunities, threats. What do we got?
All right, let's do it. So starting with their strengths, their internal advantages, they've got that laser focus on innovation, a really diverse product portfolio. Their relationships with those international brand owners, those provide a solid base.
Mm-hmm.
They're efficient with their sourcing and manufacturing. And as we've discussed, they've got a really healthy balance sheet, no debt and good cash flow.
Sounds like a strong starting point. But what about the flip side? What are some of RAY's weaknesses, the internal factors that might hold them back?
Well, the research points out that there's not a ton of information available about the management team's long-term track record. You know, what they accomplished in the past, how much experience do they have?
Right.
That could be a bit of a blind spot for investors. They also heavily rely on those international brand owners for their revenue, which, while it provides stability, also makes them a bit vulnerable.
Yeah.
If those relationships sour or if those brands start struggling, RAY could feel the impact.
Makes sense.
And then being a relatively new player in the public market, they're probably a little more susceptible to any ups and downs that happen in the personal care appliance market as a whole.
All right, so those are the internal factors. What about the external ones? What opportunities are out there that RAY could potentially capitalize on?
Oh, there are a ton of possibilities. I mean, they could definitely explore expanding into new product categories, maybe even branching out into new geographic markets and forming strategic partnerships. That could be huge for them. Team up with other companies, expand their reach, develop new products even faster.
Right.
And then, of course, they need to keep leveraging those technological advancements we talked about earlier, constantly finding ways to improve product quality and make their operations even more efficient.
So, lots of exciting potential avenues for growth, but we've got to talk about the other side of that coin, the threats. What are some of the external factors that could potentially pose problems for RAY?
Well, the first thing is the personal care appliance market. It's incredibly competitive. There are some really well-established players out there with deep pockets and tons of resources.
Right.
And consumer preferences, they're fickle, they're always changing. So if RAY doesn't stay on top of trends, they could find themselves falling behind.
Yeah.
And then, of course, there's the economy. If we hit an economic downturn and people start tightening their belts, that could definitely impact demand for their products. And finally, we can't forget about those regulations. As we talked about, the regulatory landscape for medical devices is a complex beast.
Sure.
It's constantly changing, so RAY is going to need to be very careful and make sure they stay in compliance to avoid any headaches down the road.
That's a really thorough breakdown. So, looking back at our deep dive into Raytech Holding Limited, what are the key takeaways for the listener?
So, to sum it all up, RAY is a relatively new company on the NASDAQ, but they're operating in a market that's expanding, the market for personal care appliances. They've got a strong track record of revenue growth and profitability, which is being fueled by their innovative spirit, that diverse product portfolio, and those key relationships they've built with big-name brands. And financially speaking, they seem to be in really good shape, but we can't forget that it's a tough industry. Lots of competition, demanding consumers, and those ever-present regulatory hurdles.
So what advice would you give RAY based on all of this? What should they focus on to really cement their position in the market?
Well, I think it would be smart for them to try and increase their brand recognition, not just among those big brands they work with, but directly with consumers. They should also seriously consider exploring new markets, geographically, and expanding their product lineup even further. And in this industry, you absolutely have to prioritize research and development.
Right.
Stay ahead of the curve, embrace new technologies, and of course, they've got to stay on top of those regulations. Being proactive and making sure they're in compliance, that's absolutely crucial. And one more thing, I think it would be helpful for them to be a little more transparent about their management team and their ownership structure.
Okay.
And I think it would build trust with investors.
Right. Well, it's definitely been fascinating getting to know RAY better.
Yeah.
And it makes me wonder, given their unique position, designing and sourcing for these major brands, and considering how quickly personal care technology is advancing.
Yeah.
What kind of unexpected product categories or features might we see coming out of RAY in the future?
Interesting question.
Could they develop something totally new that reshapes the entire market? Something to think about for sure.
It is. And if anyone out there found this deep dive into RAY particularly interesting, and you're curious about those global supply chains that drive so much of what we consume, well, you might want to keep an ear out for our upcoming episodes. We'll be exploring the world of international manufacturing and distribution networks in more detail.
Definitely something to look forward to. And if you're hungry for more in-depth company analyses just like this one, be sure to subscribe to the Stock Analytics AI YouTube channel.
And one final note. Remember that everything we discussed today is based on publicly available information, and none of this should be taken as financial advice.
Right.
And if you see any stock suggestions popping up in the comments, remember those are just individual opinions, not endorsements from us.
Thanks for listening, everybody.
Yeah, thanks for tuning in.